The average Australian mortgage holder will pay over $600,000 in interest over a 30-year loan term, nearly double what you lend from the bank from day one. And most of them have no idea how much of that was actually optional. And in this video, we're going to audit whether your mortgage is working for you or working against you. Most homeowners are paying a tax that they never actually agreed to, or at least they didn't think they did. It doesn't come up as a bill and it doesn't come up as a notification on your apps. It just drains your money every single month. And if you've got a mortgage and a decent income, there's a very real chance that that loan is working against you and you wouldn't even know it. So open up your banking apps and let's be honest with ourselves. My name is David. I'm a mortgage broker here in Melbourne and I work with people all across the country helping them achieve their property goals. I love making these YouTube videos, so if you have any topics and ideas you want me to speak about, please leave the comments below and I will get onto those videos one by one. I really enjoy doing this, and if you're enjoying the content, please subscribe to the channel, hit the like button. It's really helping the channel grow. Now that you've had a look at your loan balance, if you've got a rough idea on what your property is worth, you can pretty easily calculate your loan to value ratio. This is simply the value of the loan compared to the property's value. If this is under 80%, which means you've built some decent equity, and your interest rate starts with a 6, there is a very real chance that you are overpaying. And it's not because you're stupid or because the bank is evil, but because the banks rely on your inaction. They'll rely on you not checking. They'll tell you they want you to pay your loan off. They'll run ads everywhere spruiking offset accounts and smart money moves. They'll even say they care about your financial well-being without teaching you the basic fundamentals of financial literacy that we never learned in school. And this is where I'm going to come in. At the same time, they're going to sit there and let your rate drift higher and higher and slowly chip away at that spare cash you work so hard to save. This is what I'm going to call the lazy tax. At the practice I work at, we actively reprice our clients' loans every 6 months. We're doing dozens of repricings every single week, and I'd say about 90% of the time, we don't even need to refinance. We just ask the bank to sharpen the pencil that little bit. This is the difference between action and inaction. You can't just assume the bank is already giving you the best deal. So you need to ask yourself this. When was the last time you actually reviewed your rate? If you can't remember, now is the right time to pull out your phone, get onto the bank and see what they can do. But your rate is only the start of the story. Next, we need to check if your bucket is actually leaking. So if you've got a mortgage and you put your money into a savings account, we need to talk. Because if you're earning interest while still paying interest, you're fighting the bank with one hand tied behind your back. Interest you earn is taxable. Interest you save is tax-free. It's very simple. So if you're earning, say 4% in a savings account, but paying 6% on your mortgage, the maths is already working against you. The tax office then steps in and takes a cut of what you've earned. And suddenly that savings account is actually costing you money. It feels like it's working because you see the money coming in, but this is what's actually happening. $20,000 earning 4% interest across the year makes about $800 for you. Apply a marginal tax rate of roughly 30% and you're left with $560. Emotionally satisfying? Sure, you got $560. Financially efficient? It's not even close. This is what I'm calling leakage. Money slowly dripping out of your system that you need to put in place. And this isn't because you're reckless, but because the structure is wrong and you don't understand how to make your mortgage work for you. So you need to ask yourself this. Is your money better earning the interest or saving the interest? The answer is pretty obvious. If you had the same $20,000 sitting in an offset account against the mortgage with a 6% rate, you've saved yourself $1,200 in interest. And the best part, that saving can't be taxed. You won't see it land in your account. It comes straight off that loan balance and your mortgage term. You've already shaved 12 months off the term if you left that 20 grand in there for the life of the loan. The idea I want you to recognize here is urgency. This debt needs to go. And that can only happen when you understand the system and how you can use it to your advantage. So now you might be thinking, David, take a step back. All of my money's already in an offset account. Amazing. But here's the question. Are you sure it's actually linked? Now, it is less common than it used to be. There was once a high-profile case with a major bank where they failed to correctly link offset accounts for decades. But with that being said, I speak to people all the time who don't actually know if their account is an offset account, if it's actually linked, or worst of all, how to use it and how it can work for you. There is an easy way to check if you've actually been using it though. Go back to your statements and find the line that says interest saved. If you don't see it and you thought you were offsetting, guess what? Something's wrong. If you don't have an offset at all, that's not necessarily bad, but you need to understand how Redraw works and what that means for your future plans if you've been actively using your Redraw account. Redraw contamination and lost offset savings are mistakes you often can't undo later. So ask yourself, do you actually know how your mortgage is set up? Do you understand the features you're using or have available to you? Or are you just assuming it's fine? But a quick word on redraw contamination. This is where people opt to save interest by using their redraw accounts instead of their offset accounts. This is a completely fine way to save interest on your mortgage. However, if you ever have plans for this property with that mortgage to be turned into an investment property at one stage, you can't just simply go in and take the money you've saved in your redraw out and use it for a purchase for another owner-occupied property. Well, you can do it, but what you've done is contaminated your redraw account or your loan account. So that portion of money you've pulled out of your account, so let's say it's a $500,000 loan, you've pulled out $200,000. Now, all of a sudden, you only have $300,000 that's going to be deductible from here on out, and $200,000 is a loan for personal use. I'm not going to get down into the tax nitty-gritty. That's a question for your accountant, but just be really wary of redraw contamination. This is why everyone in the industry always talks about offset accounts. It's just a smarter way to do things. So if you're burying your head in the sand, this is the worst strategy of all. But if you want a second set of eyes on your numbers, your rate, your offset, and your structure, book a short call below. The link is in the description. You can work with award-winning mortgage brokers to help you smash your debt. Now let's start talking about the biggest lie that people tell themselves. I'll just be disciplined. I'm not going to touch the money in my offset account. Discipline's great, but discipline without a system rarely keeps the train on the tracks. The question here isn't whether you have offset accounts, it's whether you have a system that allows your offset accounts to thrive. The system I recommend for most clients looks a little something like this. We have a main account where our money comes into. This is where our income enters. Then we have our emergency fund, then a holiday fund, and then a next steps fund. This is for things like investing, property, shares, whatever your future goals may be. Every single one of these should be saving you interest and not earning it. They should all be offset accounts. And if you don't have the option for multiple offsets, you need to change banks immediately. So how do you run this properly? Well, the money is going to come into your system here. Then I want you to fill up the emergency fund first. I recommend about 3 to 6 months worth of expenses. Then once that's done, you can then concurrently fill up your holiday and your next steps account. You need to be able to enjoy the fruits of your labor. And yes, going on holidays while you have a mortgage is amazing, but at the same time, you need to keep one eye on the prize and see what your next steps are going to be. Having a system is how you save time on your mortgage and eliminate all of your non-deductible debt, because at the end of the day, that's the goal. Now, is this system perfect? No. Does it work? Yes, it does. If you've already got a system that works and you implement a credit card structure to that, amazing. The only rule, which is our North Star, is save as much interest as you possibly can. Put money in your pocket than in the bank's pocket. So if you've had a mortgage for a few years, ask yourself, is your mortgage helping future you, or is it sitting there doing the absolute bare minimum and creating shareholder profits and value for the banks? If you want to invest one day, upgrade, restructure your debt, the decisions you make in the first 5 to 10 years of your mortgage matter a lot more than you might think. Did you contaminate your redraw? Did you miss out on offset savings? Are you paying more interest to the bank than principal to yourself? These are things I see all the time, usually when it's too late to fully undo them. And the truth is, some mortgage damage can't actually be reversed. You can only stop it from getting worse. That's why ignoring it is never the right idea. So here's your little scorecard. If you review your rate regularly, your cash is saving interest, your offset is properly linked, and your mortgage system supports your future goals, your mortgage is doing its job. Well done. But if you failed one or even 2 of those checks, you've got optimization opportunities that you're leaving on the table. If you failed most of them, your mortgage isn't even neutral. It's actively costing you money and time. Now you can do this audit yourself every 6 months. Most people don't do it. That's why we do this professionally. Repricing, reviewing structure, and making sure clients aren't paying a single unnecessary dollar to the bank, while also helping you plan for your future. Because the goal isn't to have a mortgage, the goal is to be free.